Today, we're looking at an analysis of that 6% drop in SOFI stock after they announced the big capital raise.
Yeah, the one framing it as a gift for investors?
Exactly. The core idea is that SOFI is building a war chest for huge growth in 2026, and the market's fear is an opportunity.
And I get the energy. I really do. It's a strong bullish take. But our job today is to make it more robust, you know?
Make it appeal to the skeptical analyst, not just the true believers.
Precisely. Let's start with the tone right at the top.
The material's highly urgent and dismissive tone, while energetic, kind of risk undermining its credibility by just instantly labeling real market concerns as irrational panic selling.
That's the first hurdle. The weakness is right there in the headline. Panic selling? It immediately frames anyone who sold as weak hands who folded.
Right.
But it's dismissing the most fundamental rational fear there is with a capital raise like this: dilution. A $1.5 billion offering is not trivial.
So if you're an institutional trader and your model says sell on dilution news, this analysis just called you irrational.
Exactly. You've been dismissed, not engaged. And a sophisticated seller wasn't panicking, they were just doing basic math on their position.
Okay, so what's the suggestion here? How do they fix that without losing the high conviction feel?
The suggestion is to strengthen the whole argument by validating the market's first reaction before you pivot to the bull case.
Acknowledge the risk.
Acknowledge the risk. It makes your bullish conclusion feel earned, not just shouted.
So give me a concrete example. What does that sound like?
Well, instead of saying the algorithms reacted and the weak hands folded, you reframe it.
To something more objective.
Yeah. Something like the market reacted logically to the immediate threat of dilution, pushing the price down. And then you take a second to actually define it.
You mean explain what dilution is?
Just briefly, show you understand their perspective. Say something like, your slice of the profit pie gets smaller. It's a simple admission, but it tells the skeptical reader, okay, this person gets it. Now I'll listen to why they think I'm wrong.
That's a huge shift in credibility. It builds a bridge.
It really does.
Okay, so once we've built that bridge, we have to prove why crossing it is worth it. The analysis talks about the war chest for acquisitions, expansion, setting up for massive growth in 2026.
It's a great narrative. The long-term vision is there. But there's a quantitative gap between now and 2026 that we need to fill.
To fully establish this compelling war chest idea, the analysis needs a more explicit quantitative projection of how the capital raise actually impacts the near-term per-share metrics.
That's it, exactly. The weakness is that it highlights all the good stuff, the cash targets, the profitability, 8 straight quarters of GAAP profits.
All true.
But it completely skips over the immediate cost. What happens to the earnings per share right now, today? It leaves this mathematical void, and the reader has to guess how bad the hit is before the good stuff starts.
It feels like they're hiding the ball a little. You can't just talk about the reward without spelling out the upfront cost.
You really can't. It undermines the analytical rigor. So the suggestion is to add an intermediate assessment. Model the dilution.
Show the math.
Model the percentage hit to EPS, short term. And then this is the key part. Provide a realistic timeline for when the deployment of that new capital is expected to make up for it.
That turns the 2026 projection from a hope into a trackable target.
A disciplined expectation, yes.
So how do you do that without getting bogged down in spreadsheet talk? It's supposed to be a high-energy report.
Keep it high level. Just a back-of-the-envelope calculation is all you need. Give a rough percentage for the dilution based on the current market cap.
Establishes the cost.
Right. Then you immediately pivot to the return. Add one sentence that frames it like a deal with the reader.
Like what?
Something like, okay, while this raise may impose, say, an X% dilution on Q4 earnings per share, we project the high-yield deployment of this capital will fully restore and exceed pre-dilution metrics by, say, Q2 2026.
I see. So you're naming the price of the gift, but also showing the math on why it's a bargain.
Now you're talking. It's direct, it's transparent, and it's much more powerful.
Okay, that shores up the fundamental argument. Let's talk about the technicals. The report brings them in to confirm the thesis.
It does. It notes the close at 2778, calls out support in the 2690 to 2750 range.
Calls it a classic buy-the-dip setup on the 20-day moving average.
And that's fine. It's technically sound, but it could be so much more potent if it was tied directly back to the reason for the drop.
The technical analysis is accurate in identifying support levels, but it needs more depth by linking that price floor directly to the specific strategic nature of this capital raise.
Yes. The weakness is that it's a generic observation. Any stock can bounce off a moving average. But the catalyst here isn't generic. It's a $1.5 billion opportunistic move to build a fortress.
So the chart shouldn't just be reflecting a random bounce.
It should be reflecting the market's judgment on that move.
Precisely. Why is that price range the place where buyers stepped in? The analysis misses the chance to explain the why.
The technical floor isn't an accident. It should be confirmation of the fundamental thesis.
It has to be.
So the suggestion is to pivot the technical discussion away from just general patterns and into a conversation about institutional accumulation. Connecting the chart to what the smart money is doing.
Explicitly connect that technical floor to the fundamental strategy. Frame that $27 level as the battle line where sophisticated investors decided the dilution was priced in and it was time to buy into a stronger company.
That's a much more powerful narrative. How do you reframe that specifically?
You inject purpose into it. Instead of just saying support right here, you frame that 2690 to 2750 range as the institutional accumulation zone.
The place where smart money participates in the power move.
Yes. And you can suggest looking for evidence. Point to specific volume spikes on the chart after the announcement that validate the idea that the shakeout's getting rid of the tourists.
So, a concrete example might sound like what?
Wow. Yeah, that weaves everything together. The fundamental story, the price action, the volume, it's one complete thought.
It makes the technical serve the thesis, not just sit next to it.
This has been incredibly helpful. Let's just do a quick recap of the core actionable advice here.
Sounds good. First, boost that analytical credibility. Acknowledge the rational fear of delusion before you pivot to why it's an opportunity.
Second, quantify the cost. Show the math on the short-term EPS hit, and then provide a clear timeline for recovery. It strengthens that 2026 forecast immensely.
And finally, connect the dots. Integrate that technical support level with the fundamental catalyst. Frame it as the institutional accumulation zone that validates the entire argument.